Thank you all for coming. I'm Merit Jano, Director of the Finance and Economic Policy Concentration and a professor here at SEPA and the Law School. And it's my great privilege to introduce and welcome David Miller to speak with us today. As you know, Mr. Miller is the Chief Investment Officer of the Troubled Asset Relief Program, TARP, a position that he's held since 2009. He comes to this very important assignment with a long history in finance, having worked as a portfolio manager at a firm in Texas and having worked at Goldman Sachs for perhaps 9 years or so, and with an undergraduate degree in economics, leavened with training also in film, I see, and also, of course, an MBA with distinction from Harvard. So we're very honored that he is taking time to be with us to share his perspectives on how this program has operated and perhaps some overall perspectives as well. So please join me in welcoming him with us today. Thank you very much. I failed to mention you have little cards on your seat. We will be inviting you to please, if you have questions, write those on the card. I think we have some press with us today. Welcome. If you are a press member and you have a question, please indicate that on the card, and we'll try and cluster the questions during the Q&A. Pass them to the side, and someone will pick them up and bring them up to me, and then we'll make sure to cover all the issues raised. So thank you very much. Please join us. Thank you.
Good afternoon. Thank you, Professor Janow, for the kind introduction. I'll see if I can balance this and this. I am a recovering banker, so we always need a PowerPoint. I am honored to be here today at SEPA, which has been addressing international problems in the public and private spheres for over half a century. As the Chief Investment Officer of TARP, which is one of the most unpopular programs in government history, wasn't entirely sure how many people would show up. In fact, early in the program, a congressman said to me, he said, "David, my constituents hate your program. They rank its popularity somewhere between the Taliban and the swine flu." So again, thank you all for being here today. I firmly believe that a robust financial system is crucial to a well-functioning economy. It is one important component of the extraordinary economic progress that's been made in the world over the past few centuries. History has demonstrated that the financial system overall, not every piece of it, but overall, is a force for good, even if it goes off track from time to time. If you don't believe that our society needs a robust financial system, then you will probably disagree with everything the United States government did over the past 2 years and everything I'm about to say. The financial system consists of institutions and capital flows. Capital is like oxygen to the economy. Most people generally don't think about oxygen unless they're not getting enough of it, and by then they have a serious problem. Similarly, if capital is not flowing freely, the economy will begin to spiral downward. The purpose of the financial system is to allocate capital, credit, and equity efficiently to foster economic growth. This process allows savers who want future income to direct capital to those who wish to borrow or consume in the present. It aims to establish prices for all these types of risk. The system of capital flows is highly complex, interconnected, and global. As we've experienced, this system sometimes breaks down. Today, I will briefly discuss some of the reasons for the most recent breakdown and evaluate the success of the U.S. government's intervention in financial markets. I will approach this topic with somewhat of a Treasury-centric bias, given my role in TARP, but that should not minimize the collective efforts of other agencies, including the FDIC and the Federal Reserve, that took substantial, decisive, and critical action. Finally, I'll discuss the implications of these market interventions, including comprehensive regulatory reform and future considerations for the global economy. Let's see if I can get this to work. Very good. Always need an executive summary as well. Okay, by now, the general causes of the financial crisis are well known and well documented. The Financial Crisis Inquiry Commission, or the FCIC, just released a 650-page plus report which identifies sufficient blame for the multitude of bad actors. I encourage all of you who are interested in the causes to review the report, as well as other significant academic contributions written over the past few years, including many by Columbia professors. But for the sake of brevity, the following are some of the more important causes, which I'm not going to spend a lot of time on, that led up to the crisis in 2008. Abundant and cheap capital combined with weak lending standards. We had over-leveraged consumers and over-leveraged financial institutions. There were poorly aligned incentives, primarily for compensation, poor risk management by banks. There were information and risk asymmetries, which in short means customers, agents, investors, and other actors didn't understand or completely ignored the risks they were taking. There were shortcomings of the rating agency system. There was an explosion in the use of derivatives and securitization products which weren't properly monitored. And in general, there was an inadequate regulatory framework, which was fragmented, ineffective, and insufficient. There were also government policies and entities that subsidized and encouraged the overconsumption of housing. So, all of the above, and some others, helped create and sustain a real estate bubble, which made its eventual collapse ever more painful. It's just a chart showing 100 years of real estate prices in real terms. Most of you lived through this, but in case you missed it, we had a large real estate bubble beginning really in the end of the late 90s and through the decade, which is still in the process of correcting. As Warren Buffett famously said, you only find out who is swimming naked when the tide goes out. And so it was that when the tide went out in 2008, many of the largest players were very exposed. So why does it matter that some financial institutions acted imprudently or become insolvent by making bad decisions? Why not let them fail? If a non-financial institution is insolvent, that institution can reorganize under bankruptcy protection relatively smoothly. The core business, whether it is making drywall or semiconductors, can continue to operate. Not so with financial institutions. So two important concepts worth mentioning are insolvency and illiquidity. Simply put, insolvency occurs when a firm's liabilities exceed its assets, which is the definition of a bankrupt entity. Lack of liquidity means you don't have enough cash to pay your obligations. A firm can be insolvent but liquid, or it can be solvent but illiquid, or both. With a financial institution, the two are often tied. Fears about an institution's solvency usually causes a liquidity problem, and this in turn can result in potential insolvency if enough assets go into forced liquidation at fire sale prices. So to understand what occurred in the fall of 2008 and 2009, and therefore understand the response of the United States government, it is important to highlight some of the key structural problems that allow bank runs to become a systemic crisis. Over the past few decades, financial institutions became increasingly complex and interconnected. Some of the largest firms became reliant on non-deposit short-term funding, which seemed stable, but like a group of pigeons in Central Park, the funding fled at the first signs of trouble. Some banks had leverage ratios exceeding 30-to-1, meaning losses of 4% on assets would render them insolvent. Many had large, complicated derivative books, including exposures to off-balance sheet vehicles. There was generally a lack of transparency as to what exposures and risks these banks held. The largest institutions had significant counterparty exposures that spanned across borders. Thus, when the housing bubble burst, the fear of holding claims against weaker institutions resulted in counterparties withdrawing short-term funding and other forms of lending, and thereby beginning a vicious negative feedback loop. So if the underlying problem and exposure of an institution were truly idiosyncratic and unique to that institution, then clearly that institution could and should be allowed to fail, and the chances of a systemic crisis would be low. However, when most or all of the financial institutions have the same exposures, the problem becomes systemic in nature. So just touching briefly to recap in time how the systemic run began and some of the major players. First, in March 2008, Bear Stearns collapsed after a classic run in the bank scenario, followed by IndyMac in July. The government-sponsored enterprises, or GSEs, Fannie Mae and Freddie Mac, were put into conservatorship that September. Lehman Brothers filed for bankruptcy, which set into motion the acute phase of the crisis. The Reserve Fund, which is a large money market fund, if you recall, suffered losses and, quote, broke the buck, causing investors to begin withdrawing money from short-term credit markets. Bank and non-bank financial institutions such as Wachovia, Merrill, and AIG began rapidly declining as credit spreads blew out and collateral was called on losing derivative positions. Interbank lending ceased, and this is exhibited in the spike in the LIBOR-OIS spread, which is a general measure that banks charge each other over the Fed overnight index rate. This really indicated that banks didn't know the health of other banks and is generally used to show the stress in the system. As you can see, typically the LIBOR-OIS spread is 5 to 10 basis points. On September 1st, 2008, went up to about 50 basis points, and by October of 2008, the spread reached 338 and spiked even a little bit higher. The run on the financial system at this point had begun completely in earnest, and I can tell you it was quite a scary time. Banks could no longer operate at this point without government assistance, and businesses were unable to raise capital. Foreclosures were increasing, and home prices were falling, with downward projections of as much as an additional 30%. So the credit freeze ensued, the likes of which had not been seen since the Great Depression. So before we discuss the response, it is important to understand some context. Over the past 2 years, many policymakers from both sides of the political aisle, as well as noted economists and other authorities, have objected to the government's response to the financial crisis, due generally to an unwavering support for free market capitalism. Citing moral hazard, such critics of the government's actions have asked, why not let the banks fail? So quickly, let's take a look. Fundamentally, the systemic bank failures would have been catastrophic for this and other countries' economies. With credit contraction, businesses would no longer have funded new projects. Students would, like yourself, would have been unable to borrow for tuition, and consumers would have been unable to finance large purchases like cars or homes. An individual and a business's access to bank accounts, even those insured by the FDIC, would have been materially disrupted as institutions en masse would have gone into receivership and resolution. Fear causes bank runs even for institutions that might be fundamentally sound. With the economic engine broken, unemployment would have materially spiked and GDP would have dipped accordingly. This drop in economic activity in the US, which is still the world's largest economy, could have sparked a global depression. So I firmly believe that there was no better alternative than to intervene to save the system and to debate moral hazard and reform once the system had been stabilized. Historians, economists, politicians, members of the media, and the American public will review the merits of our response, as we're doing today. It'll be done in graduate school classrooms, media outlets, textbooks, and academic journals. Such a debate will ideally be undertaken under the umbrella of a stable financial system. So while TARP has garnered much of the headlines and, frankly, much of the criticism, I submit that the government's response was actually reasonably well orchestrated across independent agencies, including the Federal Reserve, FDIC, and Treasury. TARP was one pungent ingredient in the government's alphabet soup. For those of you who have served in the federal government, you understand that coordinating any intergovernmental effort is no small feat. During the first stage of the response, the federal government injected a significant amount of liquidity into the financial system. An essential role of a central bank is to provide liquidity as the lender of last resort to maintain a liquid and functioning banking system. The Federal Reserve fulfilled its mission through a series of well-designed programs with a bevy of acronyms too long to list here. These tools provided short-term liquidity to financial institutions and directly to borrowers and credit market investors. I don't have time to go through those today, but I really can't emphasize enough how important the actions of the Federal Reserve were in addressing that liquidity crisis. The FDIC has also been a significant partner through the financial crisis. Two of the agency's critical actions were creating the Temporary Liquidity Guarantee Program, also known as TLGP, which provide access to credit markets for viable institutions, and the other was raising insurance coverage on bank deposits from $100,000 to $250,000, which was an effort to restore confidence. Prior to the creation of TARP, it is also worth mentioning that Treasury took other decisive action in the early part of the crisis. Treasury had supported the GSEs and guaranteed money market mutual funds. Both were critical actions in maintaining stability in housing finance and short-term funding markets. Most Americans believe that their money market accounts with check writing capabilities were essentially bank accounts that were FDIC insured. A full-blown run on this multi-trillion-dollar industry would have been absolutely catastrophic. And yet, despite these actions, the tools available to the federal government were inadequate. Credit markets and interbank lending remained frozen. Institutions really didn't trust one another, so transacting ceased. Concerns about solvency make individual firms act rationally and in their own self-interest, but to the detriment of the financial system. So more needed to be done, but at this point, the federal government had essentially emptied its toolkit. And it's an important point to note that the federal government has enormous authorities. Those powers are expressly granted by Congress. So in order to expand the federal government's toolkit, an act of Congress was literally required. So the Emergency Economic Stabilization Act, 2008, or ESA, passed Congress and was signed into law by President Bush in October of 2008. With the dual mandate of financial stability and taxpayer protection, ESA authorized the Secretary of the Treasury to purchase troubled assets in financial institutions and make guarantees of certain assets with $700 billion over a 2-year investment horizon. ESA transactions would be voluntary, not calling for the nationalization of banks. The legislation provided the necessary flexibility to design programs targeted at the various market dislocations. We quickly went to work deploying the capital with limited resources, infrastructure, and staffing. While TARP is now a 200-plus mature organization with many functions and robust systems, I can tell you that the government startup looked very different in those early days. So before I discuss the TARP strategy and evaluate its success, it is worth making a few comments on the extraordinary challenges that we faced. In an era where the term unprecedented is used all too often, I can tell you that there really was no blueprint for decision-making other than using sound judgment and relying on what my predecessor coined the two beacons, whereby each action had to balance financial stability and taxpayer protection, and you had to chart the right course in between those two. We were often faced with making difficult decisions from a set of bad choices and had to pick the least bad option under difficult time pressure and incomplete information. The initial strategy focused on Treasury making direct purchases, as you recall, but given the increasing speed and severity of the crisis, implementing this original plan would have been too slow, too small, and likely ineffective. The situation was extremely dynamic and required constant reassessment. Rather than dogmatically stick the initial plan, Treasury adapted its strategy accordingly. Seems simple enough. The TARP strategy can be simplified 3 components. 1, recapitalize the banking system. 2, revive the credit markets. And 3, increase confidence through transparency to bring back in private capital. It is important at this point to mention that there were other important aspects of the government's recovery plan, notably the American Recovery and Reinvestment Act, also known as ARA, or the stimulus, and there were several other home preservation initiatives. Both are important, but way beyond the scope of this presentation today. We have far too little time. So in formulating an effective TARP strategy, an important balance needed to be struck. There was often huge disagreement about the best course of action. There was the do-nothing camp, let the markets work it out, and as I discussed, that was neither viable nor responsible. The opposite camp supported the complete nationalization of banks, and that was also neither practical nor desirable. I also want to note that the federal government's action, having been there, were taken to reduce the pain inflicted on what is commonly called Main Street. It wasn't to save particular institutions or executives, and not because of politics or ideology, but to avoid a far worse economic outcome for the American people. It is always difficult to prove the counterfactual, but in the absence of TARP, the economic environment would have been far worse. If there was a way of stabilizing the system without, quote, bailing out the banks, then surely this would have been the preferred option. So Treasury settled upon a series of initiatives aimed at stopping the downward spiral and allowing the financial institutions the necessary breathing room to recover. The first set of programs had the goal of recapitalizing the banking system so that it can continue to function. The first program was the Capital Purchase Program, or CPP, and the targeted investment program to purchase preferred equity, which would qualify as Tier 1 capital in viable financial institutions. Such investments included $165 billion in 8 of the largest financial institutions and an additional $80 billion in another 700 banks. Treasury further committed to guarantee certain assets of Bank of America and Citigroup under the Asset Guarantee Program. Treasury also invested $40 billion in AIG, which also got additional funds from the Federal Reserve. So these initial capital injections were done in a way to maximize the stability of the system. Many have called for more onerous terms or outright nationalization. So let me briefly explain why that wouldn't have been optimal. First, to maximize participation in the plan to recapitalize the banking system, terms had to be reasonable and consistent to all eligible institutions, be it large or small, public or private. Second, for those institutions that received exceptional assistance, taking 100% ownership or impairing creditors might have been destabilizing. Why, you ask? Because if markets suspected that the next weakest bank would be nationalized, it would have no ability to fund itself or raise additional private equity. Credit spreads for that institution would blow out, equity prices would plummet, which were essentially the opposite goals of our program. This cycle would have then continued to the next weakest bank. So I believe the decision to inject preferred equity in almost all cases was balanced and targeted approach to maximizing stability while ultimately providing an opportunity for Treasury to recoup its funds. Going to the second part of the TARP strategy, which we can come back to more later, was to help restore credit markets. Treasury launched 2 large programs which were aimed at restarting credit markets through the securitization markets. The 2 were called the Term Asset-Backed Securities Loan Facility, or TALF, and the Public-Private Investment Program, known as PPIP. And as you'll see, the theme here is we like acronyms at the Treasury Department. TALF aimed at restarting the ABS, or asset-backed securitization markets that provide credit to consumers and small businesses. PPIP was launched to restart the frozen market for legacy mortgage-backed securities and essentially help price discovery in a market that was essentially frozen and had been for a while. Both of these programs brought in private capital, expertise, and helped resuscitate the securitization markets, which are an important source of credit, albeit a smaller part of credit going forward. The final part of the strategy was to ease the systemic crisis, was to increase transparency. This came in the form of the Supervisory Capital Assessment Program, the SCAP, which is commonly known as the stress tests. The goal of this program was to promote confidence in the markets by providing a greater degree of transparency and institutional accountability. The financial system needed to be recapitalized by private investors, but private capital couldn't be raised until the conditions of the major financial institutions were known. Treasury worked alongside federal regulators to develop a comprehensive, forward-looking stress test for the 19 largest bank holding companies to determine which ones would need more capital if economic conditions deteriorated significantly more than expected. These tests forced banks to disclose significant amounts of data related to the risks in the market so that private investors could assess their health and assess each institution individually. The stress tests were essential in restoring market confidence and allowing private capital to come back in. Banks raised about $150 billion in private capital initially, which ultimately saved hundreds of billions of taxpayer dollars. It helped restore market confidence, reopen credit markets, and laid the groundwork for economic growth. Here's a list of the commitments made to date, totaling $475 billion. Be happy to go through any individual program in the Q&A in more detail. As you can see, there are quite a number of them, and each has its own story and history. Out of the 475, $410 billion has been dispersed in investments. We've received back approximately $275 billion to date and remain committed to winding down the portfolio prudently so that the government no longer holds investments in the private sector. And while much work remains, and there is considerable amount of market risk to these investments, we anticipate that the cost of the program overall will be negligible and merely a fraction of what was initially estimated. Again, it's my view that, again, subject to market conditions, The investment portfolio, when taken as a whole, will likely break even. So, a framework for evaluating TARP. In any assessment of the response to the crisis, there are several important measures. I'll offer up three. One, has financial stability been restored so that the financial system is able to support rather than impede economic growth? Two, how quickly has the government been able to return the financial system to private hands? And three, what was the cost? So first, here are a few metrics that we look at. There are many more, but can only fit two on one slide. Interbank lending rates, LIBOR-OIS spread that we discussed earlier, relatively quickly came down to normalized levels. Overall, the credit default swaps of financial institutions shown below normalized, didn't come obviously way back down to 2006, 2000 levels, given a lot of volatility in the markets, but certainly came back to more normalized levels. There are many other credit spreads that we look at, but by really all accounts, by the early of middle of 2009, borrowing rates had come down significantly, particularly for businesses, individuals, and even state and local governments. Companies began to access the capital markets again. Bond market rates fell substantially, and 30-year mortgage rates reached historic lows. Also important to note that Americans' net worth had rebounded substantially starting in 2009. And TARP has also helped create the conditions necessary for economic growth. And it's important to note that I'm saying conditions necessary because TARP by itself was not meant to start creating economic growth, merely help create the conditions. Despite that, real GDP has risen for 5 straight quarters. Private sector firms are slowly beginning to hire again, and the housing market, which is still a drag on the economy, has shown some signs of stabilizing. Economists Mark Zandi and Alan Blinder concluded that without TARP, the stimulus, and other government actions, GDP would still have been contracting in 2010 at around 4%. Unemployment could have reached 16.5%, and the U.S. economy would now be experiencing deflation. And to be sure, there's much more to be done in order to heal the economy. TARP helped put us on the right path. The second measure of success is speed of exit and the return of private capital. And we have been exiting investments far faster than expected. Banks have raised substantial capital, as I discussed earlier, and shown on the top chart there, which really shows the speed and extent that that's happened. The largest really did so in early 2009. We've also been a reluctant shareholder, which the goal is to minimize our involvement in day-to-day companies. Most financial institutions no longer have financial support, and I'll talk a little about later about the exceptional assistance firms. The bottom chart here shows, again, the Tier 1 or risk-weighted assets, essentially capital ratios, still have some room to go, but have rebounded sharply, and you can see the red component there being the TARP has become a smaller component of the system-wide Tier 1. In cases where we did become large equity holders, in Citigroup, GM, Chrysler, Ally Financial, and AIG, significant restructurings have taken place, which have created value for taxpayers and de-risked the institutions. In these cases, we have either exited our positions or begun the process of exiting, which should be completed in the next 2 years. Third measure of success is the cost, easiest to show. The financial cost to taxpayers, as you can see, will ultimately be minimal. TARP's official cost estimates from the CBO have declined from an initial estimate of $356 down to $25 billion. And that $25 billion essentially will be the amount dispersed for housing initiatives, or at least the amount that they estimate. The housing initiatives, again, outside of the scope of my activity and are not investments where the dollars are not expected to come back. Given that TARP's cost is now estimated to be no more than the housing initiatives, I think we can take stock. There's obviously a lot of work to be done, and market conditions will change the value of the investments. That being said, bigger picture, an IMF study found that the average net fiscal cost of resolving 40 banking crises since 1970 was 13% of GDP. Contrast the current impact on the deficit from the intergovernmental response, including the rescue of the GSEs, which are not included here, is projected to be less than 1% of GDP. Hopefully it will go down even further, but comparatively pretty good. So let's talk a little bit about lessons learned and some shortcomings. I think one of the key lessons learned in the crisis is that decisive and overwhelming force is required when faced with proportionally overwhelming circumstances. If you're going to intervene, then your intervention must be of a size and scope that it will literally move markets. Such an approach will ultimately result in fewer resources deployed, much lower cost to taxpayers, and a far quicker recovery. There's no silver bullet, and government officials must be willing to utilize their entire arsenal, including monetary, fiscal, and regulatory authorities, to achieve the desired result. So while I acknowledge the successes of the program, I think there were a few shortcomings, and the program has faced significant criticisms. Let me touch on a few of them. First is communications. Communicating the rationale for TARP leading up to and after the passage of visa was incredibly difficult. The message really does matter. And I acknowledge that explaining a program to the American people, perceived to be a Wall Street bailout, was and has been a steep uphill climb. We hope that the minimal cost and some of the other benefits will help people understand the necessity of the initiatives taken by both the Bush and Obama teams, and that a functioning Wall Street is fundamental to a functioning Main Street. Unfortunately, in a resource-constrained environment, we had to spend much of our time focused internally on getting the programs designed and implemented, and devoted fewer hours to explaining these essential yet exceedingly complex actions. Secondly, the strategic shift from direct asset purchases to capital injections, while necessary, allowed critics to suggest that we were changing the rules mid-game, acting irresponsibly, or did not have a well-articulated plan for the $700 billion. However, implementing the original strategy, as I said before, would have been too slow, too small, ineffective. And so the strategy was adapted. And despite criticisms we faced, and it may have put a temporary dent in our credibility, I think this decision was courageous and necessary. Third, executive compensation was a thorny issue throughout. It still is. Congress mandated that certain restrictions on executive comp, which Treasury implemented. Nonetheless, the seemingly endless litany of newspaper headlines proclaiming eye-popping banker bonuses enraged the public. Now, we had to strike a very delicate balance. Those firms receiving government assistance should have prohibitive conditions, but also needed to compete in the marketplace and retain top talent. Now, while now much of the furor has subsided, I suspect this was and will be a difficult issue going forward. I think finally, important point here is moral hazard, which has been debated through TARP's existence. Simply put, will institutions act badly in the future because they will expect another rescue? It's one of the most significant undesired consequences of government intervention, and while this was unavoidable, regulatory reform, which I'll discuss very briefly later, attempts to address this issue. So what does this all mean? What are the implications for the future? So I want to separate the impact of the crisis into three broad categories. First is regulatory reform. Second is implication for future crisis. And three, the long-term impact on the global economy. So one of the serious problems with large-scale intervention, as I mentioned, or bailouts, as people call it, is the impact on future decision-making and risk-taking. Moral hazard is simply unavoidable. And it would be entirely unacceptable to simply return to the same system with the same rules and same bad incentives and expect that we wouldn't end up in the same place going forward. In fact, because the intervention was so effective and markets recovered so much more quickly than many expected, it's even more likely that we would repeat the same mistakes leading up to 2008. So a strong regulatory response was required to improve the system. I think one of the important legacies of the crisis is a reversal in attitudes towards financial regulation. An adequate regulatory framework should provide tools for resolution that eliminates the need to choose between doing nothing and keeping a systemic institution alive simply to avoid crisis. New regulation should reduce or eliminate expectations of future bailouts and thereby reduce moral hazard. I think an important point is, though, despite that, a proper balance needs to be struck. Additional regulations should not stifle financial innovation and efficient capital allocation, which is so crucial to our strength and global competitiveness. Such a system has invented the money market mutual funds, credit cards, interest rate swaps, low-cost index funds, and exchange-traded funds, just to name a few good products. So the Dodd-Frank Wall Street Reform and Consumer Protection Act, Dodd-Frank, was initially proposed in 2009 and signed into law in July of 2010. The act does represent the most sweeping change to financial regulation since the Great Depression. At this point, many details have been delegated to various rulemaking authorities and are still being determined. So evaluating the practical implications of this evolving regulatory regime is quite premature. But just to quickly touch on the major tenets, here they are. Again, it's a very complicated act. There are many pieces to it. These are just some of the key issues. Don't have time to go in depth. If there are specific questions, I'd be happy to try and answer. But again, we've got a systemic Financial Stability Oversight Council. The act really requires that regulators impose substantially stronger prudential standards, which really will involve stress testing, living wills, and higher capital ratios. The act establishes a framework for regulating the derivatives market. There's resolution authority, as I mentioned, to break apart large institutions, and there's a Consumer Financial Protection Agency. Again, as I said before, there's a lot more to this legislation, and the implementation will take a lot of time, and a lot of debate and discussion will go into it going forward. However, when thinking about the implications of a post-crisis world, clearly the change in the regulatory landscape is one of the most important. But no matter how much we improve the regulatory system, we are always responding to the last crisis. The causes of the next crisis are likely to be very different. So let's not forget that there have been scores of financial crises over the past few centuries. It really is folly to believe that the next crisis can be completely avoided any more than future recessions can be eliminated. The sheer speed with which a financial system can collapse, combined with unforeseen events, makes timely preemptive government or regulatory action challenging. I think the answer is that regulation must be nimble and must constantly adapt to changing conditions. Better regulation can succeed in mitigating the severity of dynamics that might cause a crisis. Any regulatory regime must be prepared for unexpected events or unanticipated consequences and must coordinate globally since we live in a world of complex global capital flows. The system must have flexibility to respond to unexpected and destabilizing events. Regulators should not be faced with having no option, as we did in TARP, but to keep banks alive. And I think Dodd-Frank creates a framework for this. The crisis brought forward another host of issues that were otherwise ignored or unmasked in the lead up to the crisis. Journalist Martin Wolf wrote that the crisis, quote, catapulted us into the future. And besides regulatory reform, there will be lasting changes to the U.S. and global economy. Here are a few. So first, the crisis caused the beginning of a long and painful process of reducing private debt, which had been growing unsustainably for decades. Second, the financial crisis has exposed the issue of unsustainable long-term government deficits and liabilities in Western economies, including the United States. These issues will be heavily debated going forward. Third, housing finance will be dramatically changed. The administration recently issued a report to Congress on the future of the housing finance market. While a healthy debate will ensue, it is clear that the federal government will have a reduced role in housing finance in the future. Fourth, the global impact of the crisis has been significant. It unmasked serious financial and other structural problems facing the Eurozone that many of its member European leaders are working very hard to address. And finally, the crisis demonstrated the importance of increased economic cooperation to achieve a better balanced global economy. I think we've seen that the role of emerging economies, think G7 versus now the G20, has really changed the debate on the importance going forward of the emerging economies in the dialogue. So let me make a few closing remarks. There's my conclusion. Financial author James Grant wrote in 1992 that, quote, progress is cumulative in science and engineering, but cyclical in finance. And that remains true today, unfortunately. And while there have been scores of financial crises going back centuries, phenomenal economic progress has been sustained, which has improved the lives of millions, if not billions of people globally, despite the painful setbacks along the way. The causes of this financial crisis built up over decades. And while the acute part of the crisis is in the past, we must remain vigilant and strive for continuous improvement of the system. In short, we should not let memories fade and attitudes towards robust oversight diminish. More on a personal note, I want to share with you my path to public service. I'd always believed that public service is an honor and a privilege, but had always thought that I would do it later in my career. But when the crisis began, I wrote a letter to Hank Paulson, volunteering to join the Treasury Department wherever I could help out. I wanted to serve my country at a time and in a capacity which I best could, given my professional background, and it has been truly a life-changing experience. I've been privileged to serve alongside colleagues at Treasury and from other agencies who have worked tirelessly as a team during a crucial time. Further, I've been gratified by the many talented and dedicated professionals from both the public and private sectors who volunteered, like me, their expertise and services during the crisis. That the taxpayer may break even on the TARP program is really a testament to the commitment of many individuals and extraordinary leadership provided, notably by Secretary Paulson and Secretary Geithner. Policymaking is very challenging and can be at times all-consuming. It involves making very difficult decisions and balancing difficult trade-offs. Often you must make choices from a set of bad options with limited information. You don't get to test options in a laboratory, and you don't get do-overs. Your decisions have far-reaching ramifications that can be played out in congressional hearings, on the front pages, in op-ed columns, and in classrooms like here at SEPA and in academic journals. You will need thick skin. They say that if you want a friend in Washington, you should get a dog. You will be criticized from the press, Congress, academia, the blogosphere, not to mention the 4 oversight bodies that TARP has. The intense scrutiny and criticism is central to America's policymaking process and does help ensure the utmost accountability and transparency. Because the stakes are so high, because government policies affect the daily lives of so many Americans, the work is highly challenging and consequential. So it is my hope that once the political dust settles, economists, bankers, policymakers, historians, maybe the American people, will conclude that TARP was 1, crucial, 2, highly effective in executing its mission, and 3, unprecedented in its transparency. So in closing, I want to reiterate that TARP was never meant to be an economic panacea. Our economy still faces many challenges, high unemployment, fiscal imbalances. But I think TARP played a necessary role in restoring financial stability, which allowed policymakers the ability to focus on the recovery. I hope that TARP teaches us to be vigilant in identifying and proactively meeting future challenges in the financial system. These challenges will look very different than the recent storm, and facing them will not be easy. So I applaud your decision to attend SEPA to wrestle with the mounting global challenges and for the many different and consequential career paths you will take in the future. I encourage you to lead with your passions. I hope that many of you will heed the call to serve your country at some point during your careers. Our country's future depends upon talented individuals making significant contributions through public service. It is only through the efforts of dedicated individuals that positive change can be accomplished. So thank you for the opportunity to share my perspective with you today, and be happy to take any questions.
I'm not saying the need for that, but I'm just wondering institutionally whether Treasury and the Fed retain the discretion to design these kinds of instruments, or whether this whole reform framework has reduced flexibility.
I think that's a great question. I mean, I think as you said, the goal of Dodd-Frank was to make sure that there would never be a need for TARP going forward. I think specifically capital injections to keep institutions alive wouldn't be necessary, and particularly because there's now a resolution authority. That being said, I think a lot was learned through this process. I think particularly from the Fed in terms of liquidity programs. Again, hopefully those don't have to be used, but if they're used prudently, I think there was a lot to learn there about bringing in private capital and expertise and essentially creating programs that phase themselves out over time. Again, a central bank, if they're going to lend in a crisis, you want to design the program so that they are relatively more expensive than normal times, but cheaper than the stress times. And I think if you can design a program, and we saw this, for instance, in the TARP, where when there was absolutely no market for asset-backed securities and prices were 15 to 20% yields for things that used to be, essentially 50 basis points over LIBOR, designing a program that was extremely attractive at the beginning, compressing the spreads down to a point where actually borrowers didn't want to use the Fed because they were more expensive than the alternative. So I think some of those issues were certainly things that can be learned again. And then finally, the people. I think Treasury will need to expand significantly given a lot of the initiatives under Dodd-Frank and being able to utilize some of the investment and legal talent that's come over to TARP. When TARP winds down in some of those areas, be it resolution or the Office of Financial Research, I think you'll be able to bring the expertise, but again, the authority granted under ESA to invest in new programs has expired. I suspect it will take policymakers a very long time before they're able to go near anything sounding like TARP, which, as we know, is a four-letter word.
Okay, thank you. Let me read you some of the questions that I can read. Some of this handwriting, I'm afraid I'm not sure I can. I'm not sure you're alone. There are quite a few a little hard to read. But one question is, how have we really reduced the risks of bailouts?
Well, I think it's a good question. I think first, in the near term, let's talk near term and longer term. I think in the near term, the first thing that's been focused on is capital in banks. And I think you've seen really a significant increase in capital ratios, and that's continuing. Regulators are very focused. Institutions have gone out and raised capital, will continue to do it. So the ratios are not only right before the crisis, but significantly higher than well before the crisis. So I think that's one, and that's an important part of the health of a bank. Longer term, again, it's going to depend on the implementation of Dodd-Frank, which really is in its early stages. So I think better oversight is critical, and there's a lot of work to do. Having been part of a startup within the government bureaucracy, it is very challenging. Things that you, I think, from the outside expect exist, like massive infrastructure and hundreds of qualified people, just simply doesn't exist. It takes a long time to actually go out and build these important pieces of oversight that will, I think, make the system, even more stable going forward. But those are big challenges, and again, I think time will tell how effective, given what's built up. But it's I think a little too early to tell. But I think looking at measures like various credit metrics, looking at capital both here and globally, and I think in some ways we're ahead of some other countries, and perhaps other parts of the banking sector, particularly smaller banks, are more challenged. We can talk a little more about that. But I think, so the system is more stable, but there's a lot of work to do so that there isn't another big destabilizing event.
Okay, thank you. Here is a broad philosophical question about the banking sector. You said that a healthy banking sector, Wall Street, is vital to the well-being of the economy. In the long term, should we and can we decouple the fortunes of the nation and the risky parts of the financial sector? In other words, can we ensure that the health of banks that are in the business of lending, while at the same time paring down the influence of parts of the banking sector that do not contribute to real wealth creation or a social purpose? I think it's an interesting question. I think decouple is difficult because everything is so interconnected. I think there are certain activities that go on that I think are just harder for people to see how it touches their lives. Responsible securitization, for example, isn't by itself dangerous. It just needs to be done under better oversight and better incentives, et cetera. But I think that creates, essentially funnels credit
to people in a different way than your classic bank lending arrangement, but it doesn't make it fundamentally wrong. And as we saw, when those markets shut down, that has a direct impact. People couldn't get an auto loan, and that's because a lot of auto loans are done through securitization markets. Now, they may be lower in importance going forward, and banks may pick up some of the slack. But again, I think you can't expect to go back to a 1950s banking model. So that's, I think, that's one point. I think another point is that Dodd-Frank is going to reduce some of the activities that some people may see as not core to basic lending, and a lot of the details need to be worked out. But Volcker Rule being one example, as something that bank holding companies, banks that enjoy I think a lot of the privileges that come with that, be it FDIC insurance or access to Fed windows, those will no longer be doing certain types of proprietary investing under the rules, and the details are getting worked out, as I said. So I think there has been some progress made there, but again, there are different types of institutions in the system, but we can't pretend that they're not completely interconnected. So you can't just separate them out and say one we can just let sort of go down and then everything else will be okay. At least we couldn't in 2008. But going forward, I think there are significant changes.
Okay, thank you. Here is a question from a person from the press. The U.S. Treasury owns 92% of AIG. When do you plan to start selling your stake, and how confident are you of recovering the entire investment?
Okay. Yes, we do own 92% of AIG. As many of you know, in a restructuring that occurred over many months but is now closed, as a result of that, the Federal Reserve, which is a big lender, has been repaid, and Treasury owns just over 1.6 billion common shares, which is the 92%. There are 8% that trade in the public markets. Currently, that is our best barometer of what the stake is worth. And so the plan is to sell in an orderly fashion without being highly disruptive, but also trying to move reasonably quickly over a period of time to sell those in standard capital market transactions. I'm somewhat limited on what I can say, given that process has begun. There are SEC rules governing disclosure. But I can say, looking at the blueprint from our other two very large holdings, Citigroup, we owned over 25%, and we monetized that over the course of a year in a number of different ways. And then General Motors, as you know, we owned 60% of that and did a large public offering. So I think looking at the spectrum of our toolkit, that is how you should look at what we're going to sell it. But again, trying to do it as quickly as practicable without destroying value. And there's a spectrum of time within there, so we're not going to hold ourselves to a particular date. But we are going to sell as soon as at least the first part of it, as soon as we have the opportunity, and we'll evaluate it from there.
Okay, thank you. We have a collection of questions, a couple of questions about executive compensation, and they kind of cut in different directions. One of them notes that executive compensation and its relationship to risk-taking can be said to have been overblown by the media and the American public, resulting in sweeping regulatory changes to align executive compensation with shareholder interests. Do you agree with this or not? And then a further question, what would you like to see in the rules on executive compensation? And that's a press question. Okay.
So first and foremost, a lot of the regulation is getting discussed right now in terms of what things will look like going forward. I think there's general agreement that incentives need to be aligned. I don't have a particular view on the overall size of executive compensation. I don't think that's a major issue. It is how that's determined and what are the incentives. So I think the general premise of looking out over a longer time horizon, which both certainly reduces the gaming going into sort of 1 year time horizons, and then having the ability to claw back. As we saw in the crisis, there were paper fake profits that were based really on fiction, and I think those are areas which you're trying to solve for. Again, I think there are lots of ways to do it. I think we need to be very careful not to create another set of distortions. So I think a broad-based principle of more compensation in the form of equity, more deferred compensation, these are all steps in the right direction. I don't profess to be an expert on it. I think As far as, shareholders, I think it's always good for shareholders to play a more active role in the governance of their company. I think there'll be, you'll see more on say-on-pay votes, and I think, again, that's something is more about corporate governance, but shareholders need to do their part to essentially to vote and guide boards as to what they feel is appropriate. But again, I think, there needs to be balance. I think you don't want a situation where certain parts of the financial system have certain regulations, other parts don't, particularly since we live in a global economy. There needs to be a lot of coordination there, because then you'll end up having similar forms of, instead of regulatory arbitrage, you'll have compensation arbitrage, and I don't think that's beneficial. So I think it needs to be done carefully, it needs to be done sensibly, but again, along the same themes of longer term horizons.
Okay, thank you. Let me raise two last questions. First is this issue you just mentioned of regulatory arbitrage. And one question here from a second-year student is, does the existence of many regulators and agency overlaps create the ground for big banks to circumvent the rules, or has that been resolved?
I think it's a great question. I'd like to say it's been fully resolved. I don't know. I think time will tell. Different countries have different regulatory regimes. And so those that have one centralized regulator still had similar problems versus a fragmented system. They were different issues, there were different lapses in oversight. So it's not to say one is definitely better than the other. That being said, there needs to clearly be more coordination, and I'm not sure I know the best way to do that. So I think Dodd-Frank brings in some of this sort of someone sitting on top, having data to look at all of them. But in the real world, and I think that works very well in theory, I think practically speaking it will be difficult, because institutions that exist, that have long histories, have literally have personalities, tend to do things their own way, and that creates these separate entities. So I think it depends, and we'll see, but I don't think it's definitively yes that's been solved, but time will tell.
One question here is, in light of TARP's outcome, what do you see as the future of the GSEs in terms of government assistance and the size and scope of measures going forward?
Good question. Obviously played a big role in mortgage finance, and I think, as you know now, particularly now, the GSEs account for a very substantial portion of mortgages. So thankfully, I didn't have to come up with an answer. The administration just released a white paper on the future of housing finance. And I guess I'll just simplify it, and it's still, going to get debated. But from a spectrum of the government should do all housing finance to the government should have no role, it's sort of, now we're here, okay? So I think the administration has put forth a set of options which are along this spectrum, and one is a little closer to totally private market, and the other is maybe a little more activity in certain cases. What are those cases? I think, again, the purpose originally of the GSEs, you want a stable mortgage market. I think there are benefits to, in times of stress, for people to continue to be able to get mortgages. So I think that's one area getting looked at, which is only providing, there only is a role for the government in times of stress. And then again, it's on this spectrum that I think Congress will need to debate and will debate going forward. But there will definitely be a diminished role, which is right now the government is the role in mortgage finance. And I think, as you saw, the most important point, the reason why Fannie and Freddie will ultimately be wind down, I mean, done so responsibly, done so with still honoring its obligations, is that you can't have a system of privatized profits but socialized losses, which is essentially what occurred. So going to be dramatically changed, going to be debated going forward. If you have ideas, we'd be happy to listen to you. And if you have strong ideas, talk to your congressman, because they're going to ultimately have to debate. But I think that is something that needs to be done carefully, and it'll probably take a few years before final legislation comes out.
Well, thank you very much. You've been very generous with your time, and we're very grateful to you. I think we will have an opportunity for students to remain after this session for an informal, very off-the-record kind of just exchange of views. But before we do that, please join me in thanking Mr. Miller again.
Thank you. Thanks for all for coming.